Welcome to Stop Whining About Real Estate. Join us as we chat, sip, banter, and wine with the best in the biz. Grab a glass of your favorite vino, sit back, relax, and let's wine together.
Hey, welcome everybody. We are on Stop Whining About Real Estate. I am your host today, Emmanuel St. Germain. I've got my cohort, Sarah Birnbaum. We've got a special guest for you today. He's a good friend of mine. His name is Tim Renfro. He owns Travers Hartnett Insurance. Welcome to the show, Tim.
Thanks for having me.
Of course. So Tim is, so specifically what I want to talk about today and what he specializes in, he's an insurance agent. He does do some personal lines. Personal lines, for those of you who don't know, would be when you have your home, your auto, your cars, things like that, jewelry. But specifically more what I want to talk about is going to be the commercial side of the insurance business. And for us in real estate, really what that translates to is going to be condo insurance, master insurance policies, because it is such a big deal in our industry. But before we get in the exciting topic of insurance, which I'm sure everybody's really excited, we got coffee today instead of drinks because we wanted to make sure this is going to be absolutely awesome for you.
Cool.
Really high charged.
Yes, high charge. I think I even went with the high test one today.
To keep you awake.
Oh boy.
Exactly.
Talking about insurance is something that's fun.
Start with your journey. I know you're from Kentucky. I don't know much else. Well, I do, but they don't. So tell us a little bit about yourself. Get us started.
Yeah, insurance is the only job that I've ever had. Okay. I went right out of college into insurance. I actually was working at part-time cleaning tennis courts at an indoor tennis facility. And that's
Did you go to college in Kentucky?
I went to University of Kentucky.
All right.
University of Kentucky.
So you're a Wildcat?
Yes, I was a Wildcat. I was a baseball player in college, yes.
Okay.
Very
Yes,
good.
yeah.
What position did you play?
I was an outfielder.
Okay. Very
I
cool.
was very fast. And I was a very good football player, too. I actually had signed a letter of intent to play football at the University of Tennessee.
Wow.
Yeah, and that's when Johnny Majors was the coach 2 years after he'd won the national championship at Pitt.
Weren't you there at that time, Sarah?
Yeah. Tony Dorsett was his star running back. Okay, so insurance is the only job I've ever had. Okay, and I've always worked in commercial insurance, and so I was obviously a trainee, then a producer, and then I became a principal at Van Meter Insurance. I moved to Florida in 1998. We actually formed a Florida admitted homeowners insurance company. And I spent 4 years, 3 years, 3.5, 4 years as the president of American Superior Insurance Company. So I got on the personal line side, but my expertise was always in commercial insurance, large accounts. I've started 5 self-insurance funds. I've formed 3 offshore captives, and I specialize in what you would call alternative markets, reinsurance related. So
your resume is pretty decent, is what we would get out of all that.
I was blessed to have a major shareholder, a mentor, that wanted to try most anything, and I was eager to learn.
What was the big hurricane you guys had?
Andrew?
So when Andrew...
I was around for that one.
I know.
92 or 3.
Yeah, it was. Yeah, I was. Yeah.
What was it, 92?
Yeah, I was in elementary school then. I was in 4th grade, I remember.
Yeah, I'm not sure I believe that. But nonetheless, let's keep going. So during Hurricane Andrew, it changed all the regulations in terms of how houses had to be built, right?
It changed a lot of things. You know, in retrospect, looking back, the state of Florida was blessed of the area that Andrew hit. Yeah. If it had hit 15, 20 miles further north, it would have been right downtown Miami.
Yeah.
Wow.
It hit Homestead pretty bad, and Homestead at the time wasn't built out the way that it is now. It was a lot of farmland, and it was housing, but it was not nearly what downtown Miami was, or any Fort Lauderdale or anything else.
It was dense of a population.
Yeah.
I guess because where I was setting that up was that obviously with the Champlain Towers and what happened on their collapse, I think was it 21, June of 21, something like that? A couple years ago, at least, whatever it is, that has changed our condo world completely.
Yeah.
in terms of how we finance. So I'd like to hear the insurance implications and how you've seen that change as you write master insurance policies for condominiums.
When we're talking about condo insurance, we're talking about, let's divide it in two totally separate sectors. We're talking about wind coverage that covers hurricanes, and then when you're talking about what happened at Surfside, wasn't it Surfside?
Mm-hmm.
Surfside, that had more of an effect on what we call the liability side of insurance. As a direct result of Surfside, we lost over half of our markets that would write umbrellas, directors and officers liability.
And when you say markets, what you're saying is the insurance companies that you would go out to market. So, people know Progressive, Allstate, they know certain company names. Half of those companies went away is what you're saying.
Yes, we lost those markets because I don't know that the industry had a true understanding of what could happen.
Yeah.
That it was tough. It was tough. And so we saw that. We saw that in those times, inspections of buildings that weren't being completed. We saw cities that were lax on it. So they started the 40-year certifications, even though it was in Miami-Dade and in Broward County, it was in effect, but it wasn't being regulated or enforced as it should have been.
Yeah. So, that's a big issue for us today. It's definitely one of the first questions that we ask, depending on the age of the building. Have you had your 40-year inspection, and what does that look like?
Yes, and the 50-year recertification,
right,
and all those things. Yeah.
The some of the challenges, I guess. So, talk about your underwriting process. When let's say if Sarah lived in a building and she was on the HOA board or condo board, excuse me, and they wanted to get a master insurance policy through a company, through you as a broker, you're shopping it out to different markets to get the best ones. What does the underwriting process look like? What are they looking at in terms of a condo? How are you determining policies? And then we're going to get into deductibles, because some of those later on are part of what has affected my world, the financing aspect, which affects the realtors and everyone else. So
the physical characteristics of a building, if we're talking about wind coverage, has more determination on what the cost is for your insurance. How far are you from the ocean? Mm-hmm. What's the construction type? Is it a fire-resistant building, meaning a concrete building with a concrete roof? Or is it a joisted masonry, meaning it's a block building with a wood truss roof? Do you have opening protection? What do I mean by that? Do you have hurricane shutters? Do you have impact glass windows? How old is your roof? Those type of things do more. We insure about 300 residential community associations. And so we're a decent size agency, but I would love to tell you that because I'm a decent size agency that I can get you a better price than a smaller agent.
Right.
But that's really not true. The price is not determined on how big your agent is. The price is determined upon the physical characteristics of the building itself. Like big agents like to go out there and say, oh, we're big, we're going to get you a cheaper price. That's not how it works. Now, what I might know, or what a larger agent that has experience might know, we might know how to put that package together better.
Sell it better. Yeah.
Better presentation, just like in your business. Mm-hmm. Yeah. So it's all in the presentation, professionalism, knowing what you're doing. But the characteristics of your building, if you're 10 miles from the coast, you're going to have a cheaper win rate than if you're right on the coast.
Right.
The general theme, what occurred in your commercial insurance for condos over the last 3 years has been a steady doubling climb. Give a little bit of the climate background so we can talk about what we're going to do.
We mentioned Andrew in the beginning. Okay, so in 1992-ish, Andrew hit, and we saw a hard insurance market. Hard means rates are going up. That we weathered that storm through then. Then it went literally that storm. So we go from 92 to basically 2004.
Wilma.
We go 12 years before we have any major hurricanes that make landfall. Mm-hmm. And in 2004 and 2005, we have a brand new phenomenon that happens. We have multiple events in the same year.
Yeah.
So out of that, we end up having 3 storms one year and 4 storms the next year. So we end up with a before that, deductibles.
We say we, and I don't mean to cut you off.
Well,
I
the
just
state
want
of
to, because so that is something I want to talk about. What happens when a Katrina, because Katrina went right over me in Boca, but it was nothing here. But obviously when it hit New Orleans and, you know, it made tremendous issues for that area. Obviously, does that, I say obviously, does it affect our Florida markets, even though a hurricane hits in Houston, in Louisiana, and other parts?
Absolutely. It's the same reinsurer that if you hear about a typhoon that hits Japan, they're going to have the same reinsurer that we have for hurricanes in Florida. If you hear about a mudslide in California, if you hear about thunders, or if you hear about tornadoes through the Midwest, any type of catastrophic event is going to have an effect on the market, okay? And so since we live in Florida, we have more hurricanes than, say, maybe Georgia, maybe Texas, and what have you. So when we have those events, their rates are effective and they're subsidized. We're
still absorbing it here. Yeah, everybody does.
So we went through the 04 and 05 storms, and we went through a period of time from about 2006 to about 2009. We saw an incredible rate increase. No carriers wanted to write. What a lot of people don't remember in insurance is starting about 2010 to about 2021, we saw rate reductions every year. So we were heading into a hard insurance market in 2021, 22. And then we have Hurricane Ian. Mm-hmm. We're already in a tough market. And then we have the second largest hurricane.
That's one that hit Fort Myers?
Yes. Okay. The second largest, next to Katrina, which hit New Orleans, the second largest devastation in U.S. history.
Wow. Okay. So the premiums, right? So just to go back and simplify it back to the condo world, is that Sarah's building, her condo association, her master insurance was $100,000. And because it was $100,000, her HOA dues were $500 a month, right? Her condo dues. The premiums start climbing through the roof. They get to $200,000. They get to $300,000. They're going up at 100%, at 50%. The premiums are going up tremendously. And what's happened, and again, this is where I want to bring it back into real estate, is that an association that was basing their $500 a month budget based on $100,000 of insurance now has to deal with $300,000. And so they've priced themselves out. Sarah can no longer afford, and of course, Sarah's a fictitious person in this scenario, but Sarah can't afford the $1,200 a month in condo association. So now she's trying to sell her unit. Mm-hmm. So as you can see, condo master insurance has played a really, really pivotal role in the whole condo financing. And obviously living in South Florida, we do a tremendous amount of condos and we see a lot of it. One of the tools that that commercial insurance agents have been doing, which has been an issue on our side of the world, and I understand why they've done it. You and I have had off-camera conversations about it. What they'll do is they'll raise a deductible. So in general, raising a deductible reduces a premium in theory. So the idea is, in order for them to not go from $200,000 to $300,000 in premium, they'll say, hey, raise your wind deductible, that's the hurricane portion, from a 5% deductible to a 10%. I've even seen a 15% deductible in order to reduce that premium. When agents have done that, it eliminates our ability to what's called warrant a project, meaning it won't pass Fannie Mae and Freddie Mac guidelines.
So it's not financeable.
What's that?
So it's not financeable.
It's financeable, but we have to go through, just like he has secondary markets. Our worlds are so similar. It's the same thing. We now have to sell that loan into what we call a non-QM product or a non-warrantable loan And to a consumer, to the Sarahs of the world that's buying the property, all of a sudden the interest rates are a little bit higher because the risk is a little bit higher. So part of that, which totally makes sense, totally understand why they've done it. But for us, and I think that, where our frustration comes in, and I wish, so in full transparency, I live in a townhouse association, and Tim came in and he's does our insurance, but Tim comes in and knows and presents the products. One of the things that this was a business idea of mine is I don't understand why these condo associations, why they don't bring somebody like myself and you in together, and we say, hey, totally get it if that's what you need. If your homeowners cannot make these payments at these elevated numbers because of the deductibles, I get it. But please understand the following. When you do that, you now can't sell a property with someone putting 5% down. It now requires 20% down. Because you are shortening the amount of buyers, you are reducing your ability to sell at top price. Right? And now you're affecting. So you're making decisions of anybody who wants to buy. And again, it is what it is, just like budgets, right? People have to pay their bills. But talk about the insurance markets. How can we prevent this? Where are they going? And, because you've already started saying that they hopefully have capped, and hopefully that's good news for all of us.
What we're seeing, and the market moves very fast, okay? In insurance market, is a nervous reaction. Not that and similar to like a stock market. We overreact to everything. So in January and February, we were still seeing rate increases in the 20 to 25% range.
Eesh.
Was about, say it went up 100% 2 years ago and it went up 50%. It was still a 20, 25% increase. We saw the market turn in about March. We stopped seeing March and April, we stopped seeing the 25 to 30% increases. Suddenly it's 10. And then by June, by late May and June, we start seeing flat renewals, same price, or we start seeing, small reductions or small increases, and in some cases, small reductions, okay? So my industry is no different than any other industry. It's about supply and demand. So more and more, as these insurance rates continue to go up, what we saw in the past is all these carriers pulled out of the state of Florida. Mm-hmm. So insurance companies have different, I'm going to use the word tricks. One way is to double your premium. Mm-hmm. The second way is, as you mentioned.
That's our favorite, by the way. We love that trick.
Well, the second thing that we see, Sarah lives in a condo, okay? And she's been there and she's got her loan approved. So each year, Sarah, her mortgage company wants an updated proof of insurance. So let's say 3 years ago, Sarah, we sent a proof of insurance to your mortgage company and you had a 2% deductible. Mm-hmm. And you live in, let's say you live in Palm Beach County.
Okay.
Suddenly after we get in this hard market, that 2% deductible, it's not an option that you could buy anymore. Your master association policy I'm talking about is now the carrier says, we don't offer 2%. Guess what? We don't offer 3%. We don't, at best, you're going to get to 5%. And you mentioned in some cases, 10%. So she has an existing loan and suddenly you start getting pushback. You get pushback from your mortgage company because when the deductibles is self-insurance. It's what it is. So your master association used to self-insure the first 2%. Now they're self-insuring 10%. And so you get pushback where the mortgage company says, well, we don't accept that. But when it's all that the industry has to offer, when you can't buy a cheaper deductible, they can't force place it because they don't have the market either. And so it's all we have to offer.
It is what it is.
Yeah.
So do you think people are going to walk away from their condo in general? Like, if you can't afford it, you can't afford it. If you can't sell it because nobody else can afford to come into it and take on that $2,000 payment of HOA that used to be $500.
That's why condo prices are decreasing at a different rate.
Making up the difference.
Single family homes.
Single family.
So making up the difference for the insurance part of it.
Well, we also, a large amount, Florida's a retirement area.
Yes.
So a large amount of the condo associations or even HOAs maybe, are 55 and older.
And they're fixed income.
They're fixed income.
Yeah.
And it was a major concern for me watching the premiums go up from 200,000 to 400,000. And how can these people on fixed incomes afford this? And I would go into these board meetings. I would have people crying.
Oh, yeah, I can imagine.
Yeah.
It's heartbreaking.
It is.
Yeah.
And because they get, on paper, for a while, your real estate, your condos, you bought it for $65,000 in 1972, and it's worth $350,000, $400,000.
Right.
But your Social Security check's still the same.
Right.
Yeah.
Yeah.
Can you talk a little bit about Citizens and what exactly is Citizens? We're located in South Florida, and Citizens is a what company?
Citizens is the state of Florida, because of situations like Andrew and Wilma and what have you. We have these multiple hurricanes. Citizens is considered the market. It's termed the market of last resort. But Citizens, unfortunately, in most cases, in the last few years, it's not necessarily the market of last resort. It
the only
is
resort.
It's the primary. Well, even if there's other markets,
It's the only one. It's who I use.
primary. It's primary.
Yeah.
Because I had many situations where the private insurance companies that were still willing to insure were raising their rates at such a high level, and Citizens rates are somewhat capped by the increases that get approved. Citizens was the cheapest market.
Would you call it a state subsidized?
It's subsidized by Citizens is backed by the policy holders. It is kind of a hybrid of, you'd almost call it like a self-insurance.
Okay.
Because they can assess. They can assess the premiums, and as long as they have active members, it's so if a major catastrophe happened, the state of Florida would not come in, I don't think, and I don't think they have the capability to do it, and what you call bail Citizens out. Okay, we're policyholder would do that, and if the state did do that, how would they do it? They'd raise taxes. They'd put a tax on us.
It's gotta come
We'd
from
pay
somewhere.
for it. We would pay for it. So,
Yeah.
so Citizens is a state-run organization to make sure there's a market. Okay, but a lot of people question the financial stability of Citizens. Citizens, when I first started doing business in Florida, like I said, I did a Depop, and it was back before it was even called Citizens. Back then, it was called the JUA, Joint Underwriting Alliance. They rebranded themselves, changed their name. So they do these programs all the time trying to entice insurance companies to come into the state. They'll pay bonuses and bounties.
So you do a Depop all the time, don't you? I have no clue what a Depop is.
I don't know what I was gonna
Depopulation.
ask.
So we would go to Citizens, like an insurance company would go to Citizens, and we would look at their data, and we would pin certain policies that fit our profile.
Right.
And we would take it from Citizens. And Citizens, if you kept that policy, in our case, if you kept that policy for 3 years, then they would pay you a bonus for taking it.
The reason I brought up Citizens is that we've been made aware on my industry in the lending portion that if the master insurance is held by Citizens, Fannie Mae is making an exception to their rule regarding the deductible, and we can get it financed all the way to 10% deductible.
Really?
Only with Citizens, which is why I asked about its backing. Obviously and I didn't know if it was state subsidized, if it was federal. Like there's something within the state regarding Citizens, but that's why I'd asked the history.
If Citizens had a catastrophic or casualty where they had a shortfall of money, what would happen? Here's what Citizens would do, and here's what they did in 04 and 05. They would go out and borrow money. They would buy a bond.
Kind of like when a bank fails and somehow we as taxpayers, instead of letting it go, we bailed them all out.
They would buy a bond, and if I was a policyholder, they're going out and essentially making a loan on my behalf. They're negotiating the terms, and then Citizens would tag an assessment onto the policy that we would be responsible as policyholders. Your policy, my policy.
Are you also a Citizens
Yes.
policy? Okay,
Yeah.
so we're in the same boat.
Yep.
Okay.
They would tack an assessment on there, and you and I are responsible for repaying that assessment, it might last 5-10 years.
Very good. Off topic real quick. I have to say,
Scared.
Janine and Sarah, Janine is who runs our podcast, our amazing producer. You girls did an amazing job. We look like the two ferns. I would like to ask some really weird questions like Gafalnicus does. I know I butchered his name. I can't say it.
Gaffinopoulos.
I don't know. We could do a whole show on trying to pronounce his name.
Something.
However you say it. But I think you guys did amazing. I really like
Thank you.
Yes. So
I was
by the way,
shopping
great job.
in Target, and
That's where you were all day.
well, it was an hour.
Oh.
I had a lunch, and I was here all morning. You just didn't notice. You were in meetings.
Some of us were writing policies.
Yes.
Right, Timmy?
We were in a meeting at 6:30 this morning.
Yes.
The two of you together?
We were. Listen,
cozy.
I am a busy bee.
I'm fully aware. That's why I don't bother you with this stuff. I just go out and do it.
I know. It looks
And then
great.
when you notice that I'm
guys did a
missing,
great
you send
job.
me a text, has anyone seen Sarah? And I respond, I have.
All right. Back on track. But anyways, great job, ladies. Wanted to make sure you got full
Thank you. I
credit for
appreciate
that.
that.
As much as I like to take credit, I have no credit for this.
Perfect.
Tell us a little bit about where you see the insurance going, both personal lines and commercial lines, just in general, and please be hopeful.
Yes, well, as I said earlier,
We need it affordability wise.
Yes, as I said earlier, we've seen the market turn positively since January to, if we always use this term, if the wind doesn't blow. If we do not
season's
have,
coming.
We are in hurricane
We're
season.
in hurricane
Yeah.
season. Yeah.
If we don't have a major event to make landfall, and we're successful, I already have read where there's 2 or 3 homeowners companies that have filed for rate reductions. Okay, so I would say that I know reinsurance cost is going down. Okay, reinsurance cost is going down,
Which is a good sign that insurance is next. So it's domino type thing.
Yeah, insurance. What is reinsurance? Reinsurance is the insurance that insurance companies buy to protect themselves. Okay,
Insurance on insurance.
Insurance on insurance, and so we're seeing more players come back into the market. So we like to use the term capacity. So we've got more capacity, and so we can. And when there's abundance of capacity, there's competition, and rates come down. Just like my industry is just like any other industry. So if the wind doesn't blow, as I like to say, you'll see you're going to see a lot more companies come back into Florida because the rates are up there. So insurance companies say, "Oh, we can make good money right now," and so we can undercut the market a bit and lower your rates and come in and write very favorable risk. We can cherry pick the newest constructions, the best built, and we can get the cream of the crop and make good money.
When insurance companies come into a market, is it state related? Is it area based? Like, are you going to New England or is it Massachusetts, Maine, New Hampshire? Like, you going to different states? How do they decide to go into an area?
Well, an insurance company will look in an area or look at it at a facet of the insurance industry, saying, okay, listen, ABC Insurance Company may specialize in this type of coverage. XYZ Company may say, we specialize in another type of coverage. So where there's the most volume, 80% of we talk about the master associations and all that, I would say 75 to 80% of the premium they pay is just for wind. So that's where it's at, okay?
So we're obviously not in California, but California is a hot mess. They've got a lot of their own issues. Forget politics aside, but just the actual. No, I mean they have mudslides, they have droughts, they have this, they have that. And of course they can't pay for any of it, so they borrow money from Florida.
But one of the
taxpayers.
really odd things in our industry, I was on a Zoom call about 2 years ago, and so-called experts, and I've got 3 screens there in front of me, and so I'll sign up for these Zooms, and I'll put it on one of my monitors and work, paying a little bit of attention. And
We appreciate that, by the way.
And
Make sure one less zero on my next policy, please.
Yes. So this gentleman goes on, and he is talking about liability in Florida, liability claims in Florida. And he says 78% of all homeowners' liability claims in the United States are filed in the state of Florida.
Yeah, we got a bad rap for that for a second. I don't
Well,
think
it's true though, but they also talk about tort was a major issue,
Yeah.
and there was
Yeah.
some reform on that, right? Or
Yep,
no?
yeah. And so I'm like, I don't believe that. I'm saying, did I hear that correctly? Was I paying close enough attention? I'm thinking, okay, we've got New York, we've got Illinois, we got California,
Texas.
yeah, these liberal, California being a liberal state.
True.
And so I just go on one of my other monitors, Google liability suits in the state of Florida, and right there it pops up. The very first one was business insurance, 78%. Actually, he said 77. It said 78% of all liability claims are filed in the state of Florida. Of that 78%, the majority of those, 80+% of those, are in Tri-County. So they moved to Dade, Broward, and Palm. People move in here and they file claims. And so liability rates are outrageous. Insurance companies cannot make money.
Just taking a guess, what percent of those do you think are fraudulent claims?
Never a fraudulent claim. I mean, I got about 2 years ago, I got called to a jury duty.
Mm-hmm.
And the case,
I've never been on jury duty. Have you?
I've actually never been called.
I've never been asked either.
the case
you
that
For
haven't?
sure, I'd be picked, but I mean,
Well, maybe not though. But also,
I'm
you're.
very analytical. I think I'd be a very good juror.
I think they'd want to throw you out because it would take you. You would just be too much for everybody.
I definitely would control the juror room.
Also, you're a citizen?
Of course, I'm a citizen.
Got it.
the case that I was called to, pardon me for interrupting y'all's
No, you're good.
conversation. The case that I was called to, guess what? It was a auto insurance claim.
Okay.
This guy was suing an insurance company, and so they go around and panel the jurors. And when the judge came to me, I said, "Judge, I don't think they want me." I said, "I have a
Pretty good understanding of this.
decision. He's guilty. In my mind, I work in the insurance industry, so it's just tough." I was on the phone with a claims adjuster in New York 6-8 months ago, and I was giving her abuse about paying a claim that I didn't think should be paid. It was obviously, my insured had done nothing wrong, and they were upset because even though think about a liability, almost every insurance policy, think the premium you pay, you're renting a policy.
Right.
If you've got $1 million liability coverage, you're renting $1 million. We're charging you $10,000 in premium, and we're going to, from June to June, we're going to provide you $1 million of protection. Mm-hmm. So when you pay that premium to the insurance company, it becomes their money. Mm-hmm. It's not yours anymore.
Right.
So if they pay out a $200,000 loss, it's their money. They're paying it. Now, it does affect you because it causes your loss experience to go up. Mm-hmm. So that happens. So I'm talking to this adjuster. Why did you pay this claim? And this adjuster says to me, it's your state. She says, do you think I enjoy paying a claim that I know is fraudulent? If my company never wrote another policy in the state of Florida, it'd be too soon. Yikes. It's our laws. So some of the changes that they've made as an insurance agent, I consider myself on the ground floor. Now I deal with what we call insurance brokers. And I said, we're the Marines, you're the Army, and the insurance company is the Navy. So we hear firsthand what is going on with the consumer. We hear it, we know what's going on. And I talk to these adjusters firsthand all the time. I talk to adjusters every day, and it's tough. It's tough.
Yeah.
So we see a lot of fraudulent claims. In today's world, no one is guilty of anything. It's always somebody else's fault. Yeah. So I say it's a fraudulent claim. I say there's many times, let me rephrase that, it's debatable who's really at fault. because, people think they don't do anything wrong. Well, you should have done this. You should have done that.
Right.
You caused me to have this.
What was the tort reform that happened? Are you familiar with it at all?
Yeah, to the point as far as condominiums are concerned, with the condos.
No, I just mean in terms of it. So the concept behind the tort reform, my understanding is that in order to limit the amount that people can sue for when you're suing an insurance company. And the idea behind that, again, so the whole point is that we collectively in the state of Florida and throughout the country pay these higher premiums because, and maybe it was, I don't know, it might have been health insurance related, but the point is that the concept is that because of all these fraudulent claims, because of lawsuits, and because of actual real claims, we all share in higher premiums.
Well, the example I was going to give you is that due to the change in the law, is that in many cases there is claims that there's contributory negligence. Is that, okay, something happened, you're in a garage of a...
Sorry, I left the water on.
Yeah, or you're in a garage and it's not properly lit, okay? And so I trip over something getting in my car and I have an injury. Well, you're partially at fault for that, So insurance, so the change is that we could end up having, if the association, what I was using, was even remotely at fault, they could get tagged big time with a claim. Now the way that the laws have changed is that if the association is not at least 50% responsible,
Okay.
then they...
That's why you see signs everywhere. We are not responsible for this. We are not responsible for that. We are not responsible.
Or don't enter this way, or don't walk here. So we are seeing on the ground floor. That's why I use that term. Some cases that are not. People are having a harder time getting an attorney to take the case, but the industry is not. You're really not going to see the data get to the industry for a few years. So you don't see it's not like a year turnaround. Oh, liability claims are down 40% due to this law change, because liability claims have what we call a tail, and they go on for many, many, many years. Okay, so the insurance industry is going to sit back and see. They're going to want 2, 3, 4, 5 years of data to see what the true effect is.
So you real movers and shakers over there.
Oh yeah,
Real fast moving.
Yep.
Flying by the seat of their pants.
In wrapping up, Tim, if you could please give the associations, or anybody that is in a condo association board type thing, what are some tips that they may be able to implement, use, share with their board in order to help reduce the cost of their insurance? And of course, obviously, other than giving you a call and letting you become their broker of record, which will give you an opportunity at the end to share your contact information, but give the people some tips.
Well, as I said, 80% of your premium is based upon the insuring the building against wind. One of the major things that we see today is, if I was going to give a condo association one tip, it would be have an annual maintenance program on your roof. Make sure that your roof is in good shape, because in the insurance industry, the industry has an idea or an attitude that once a roof hits 12, 15 years, it's gone.
But are you reassessing? Are you going up on that roof every year? Or?
Well, I would suggest that an association have a roofing contractor inspect their roofs on an annual basis.
And then you provide that inspection back to you.
We get first thing I want is a copy of the contract that you've got an annual maintenance program. If you're doing that, you're doing better than 2/3 of the other associations.
Yeah.
You get that. Give me a copy of that. Give me a copy of that maintenance agreement. Give me a copy of the last couple of years, copies that he's actually doing the inspections, and then show me a canceled check that you've actually done what he said that he needs done. So if you do that, then I can take that information and go to an insurance company and say, oh, well, yes, I know your guidelines say that you only want to insure this roof for 15 years, and this roof is 16 years old, but
Here's
this
what they're
association is doing better than most. And this roof maintenance agreement that you have, this report says that you've got 5 to 7 years of life expectancy left. I am the eyes and ears, for lack of better terms, of the underwriter. Okay, they don't get to go out and see it. I mean, sure, they can look at they can go online and look at the conditions of the roof. But if I provide them this is what are you doing? What are you doing to be proactive to do this? Roofs are the best thing. Obviously, the other thing is what we call opening protection, hurricane-proof
Windows
and doors and what have you. Those are the two main areas. The maintenance of your building is important. I hear people, say, well, we do this, we do that. Will I get a discount? No, you won't get a discount because you're maintaining your building. You're doing what you should do, but you will get the benefit of the doubt.
Right. Awesome. Well, thank you so much for being here. If anyone wants to get a hold of you for both personal or commercial lines, what's the best way for them to contact you?
Best way is our office is in Delray Beach. Our number is 561-243-0166. And, our attitude is we're here to help people, with their claims and what have you. Okay.
Well, thank you, Tim. Thank you for being on. And, I can personally vouch, Tim handles all of our commercial insurance needs for my company, Choice Mortgage Group, and also does my association for my townhouse. So I can personally vouch for how honest, how great he is, him coming to the meetings, explaining things in detail. So thank you very much for being a guest on the show today.
Thanks, Tim.
Okay, that's enough whining for one day. We are so happy that you could join us today on Stop Whining About Real Estate. So please, not only listen, but subscribe, follow us, download, share, and if you're feeling it, give us a 5-star review. Hey, and if you'd like to be a guest on the show, please email stopwhining@choicemortgage.com. Thanks so much.